So, Lamont, can we go ahead and just start with the roll call?
Yes. Controller Yee. For the State Treasurer, Mr. Moore.
Here.
Mr. Keeley.
Here.
Mr. Rosensteel.
Here.
For the State Superintendent of Public Instruction, Ms. Zumot. For the Director of Finance, Mr. Ortega. Ms. Higa. Chairperson Hendricks, you have a quorum?
Great, thank you, Lamont.
You're welcome.
Go ahead and take a look at item 1, approval of committee agenda and the work plan. Any comments, inputs?
I move approval.
Okay, it's been moved. Seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? Great. Good afternoon. Hope everyone had a nice lunch, a little break. Our first open session item is our CIO report. So, Chris.
We're going to try and make sure the teacher members in the cafeteria know we're starting up, because we didn't see Loretta in the back of the room, but maybe they're in the, I don't know if you know, but they've called the adjacent room is now known as the crying room, but I think it's the work room. They're over there working. I have heard blenders at a couple of times. So, on that note, here is a 35-year picture of the federal funds rate, just because I wanted to back up and get some perspective on where we stand. You know, the wild gyrations at the start of that of the 1980s when Greenspan or Volcker took over and had to tighten to ease out inflation. And the gray bars are the recessions. So you can see the Fed generally has loosened aggressively and dropped rates during the recession. But that's where you can see the long period, almost a decade of where we were at zero interest rates and now have the first uptick of a quarter. And in the closed session, the staff talked to the board, just for the public's knowledge, a lot about, you know, what is the next move for the Fed. One thing I would add, we're even hearing a few people say the next move for the Fed actually might be back to easing. Not many, but a few, because you know, there was a forecast of 4 tightenings, but we think that's off the table with the economy so weak. So here's where the fund stood at December 31. Obviously, January was a very difficult month, the worst month on record for U.S. stocks until we had a bit of a bounce at the end of the time period. What I wanted to report is it looks like our December 31, our 2015 return is going to be about 1.5%. We'll know that more in April when Alan presents the performance numbers. That compares, I just happened to get my Savings Plus. As a state employee, we're all in the 401k program in the state. And I looked at their target date 2040 fund and 2050 fund, so the year 2040, 2050. Their benchmarks for those funds were negative 3%. So our positive 1.5% might look pretty darn good relative to those as kind of a reference portfolio. Our 3-year return is 9. So all the people that talk about the low return environment, you have to realize so far the decade of the 20 teens, we've had generally a pretty positive return. We're 8.5% over 5 years. The 20-year return, so going from 1995 to 2015, is just above 7%. So you're picking up the 2 recessions right in the heart of that, and that shows the difficult period. That might be a better representation of the low return environment is what we've seen in the past, not what we are going to always expect in the future. And those returns are all net. In April, we're going to come to you with the big performance book. I'm going to create a 1-page summary that goes at the very front of that. And in keeping with what I said to you at my evaluation, we're really going to try and push longer time periods. Get away from looking at calendar years and fiscal years, looking at 3, 5, and better yet, 10 and 20-year returns. So we're going to try and do that graphically, and we're going to try and do that with our words so that we're less short-term focused, because we are long-term by nature. We're not announcing it publicly that much, but that's roughly what we think the estimated return is about to be. Here's the asset allocation. As we've discussed before with the board, we're pretty much on target in every asset class. We are underweight in private equity. That asset class takes 4 years to invest in, and so it is part of a long-term change, seeing the run-up in '06, but then the lack of investment opportunities in '09, 10, and 12, or 9, 10, 11. And that's part of our long-term discussion and plan. And obviously, this asset allocation chart is going to change once you've adopted your new asset allocation targets. Once they go into the policy, then we will adjust these. So here's 2015, was a very difficult year. One of those times where, once again, the market ends up almost where it started. You did have a very big sell-off in the middle of the fall. And then obviously here in January, we've repeated that all over again. In this index, the S&P 500, we're now below the bottom of that graph when you look at it on a one-year basis, bringing it up to January. So as Michelle said to you before, volatility has returned to the market, not uncommon, but uncomfortable. Now here's the longer-term graph if you step back and look at the last 5 years or 6 years. And as you can see, we really, as I've been saying to you, we went through a nice bull market. We rebounded off the Great Recession, but now we've been in a flattening period and more of a volatile period, and we think that will continue. Some people have forecasted that this chart's going to roll over and have a downslope on the other side. That would be the big bear versus a little bear that we talked about earlier. We don't see that happening. You would have to have some kind of a major event in the United States, not just a decline in oil prices, to cause that kind of a severe recession. We are absolutely up in the crow's nest, scanning the horizon, looking for that risk, but we still do not see it at this point in time. So when you look back at last year, here are the returns around the world. Obviously, the USA barely positive. Europe was negative. There were decent returns on the calendar year out of Japan. Obviously, China and its volatility, all the volatility we heard in China, the Shanghai index was still actually positive year to date because it went up almost 100% from January to May and then came back down. Now it's even more volatile, and I believe now on a year-to-date number it's negative. But look at the red numbers for the developed markets and then particularly the emerging markets. The emerging markets were just hammered last year. They were hammered again in January. That has a lot to do with oil, but mostly to do with the China slowdown. It has, and I've been asked repeatedly by teachers, China has a much larger impact on the emerging markets than it has on the USA. We don't sell a lot of things to China. We buy things from China, so their slowdown doesn't impact us as much. Countries like Germany and parts of Europe and Japan have a much bigger impact, and Korea with the China slowdown.
Before you go on to the next slide, can you just remind us, because I'm just thinking of folks in the room, I know when we've talked about emerging markets, even in the time I've been on the board, that's changed a little bit in terms of what we mean or who we're talking about. Could you just kind of
Sure.
remind us of when we say emerging markets, what areas are we looking at?
Yeah, the different asset classes define the actual criteria differently. We generally are going to use, and I will talk in terms of the equity markets. Developed markets are the largest nations, about 22 nations. And those would be the major countries you tend to think about around the world. Emerging markets would be the next layer down. The largest would be things like Mexico, South Korea, South Africa. Last couple of years ago, they coined the phrase BRICS, which everybody now thinks about: Brazil, Russia, India, and China, the most populous nations, but not actually the largest emerging markets. They're coming on board, but last year was a good example where they had tremendous difficulties. And then there's a layer below that, which would be the frontier markets. In June, correct me, I think there's 28 emerging markets. 23 emerging markets. Can't rattle them all off, but you would think of them as more the smaller countries that have a developing economy. There's a committee that decides what becomes emerging and when it becomes developed. Greece would be the latest example of a country that went from emerging to developed back down into emerging. Malaysia is a company that waffles back and forth sometimes. Korea, I would tell you that because we participate in that committee, Korea, South Africa are the ones that are on the edge. It has a lot to do with their currency translation. The frontier markets are more South Africa and sub-Saharan Africa and in the middle of Europe. Now what we've seen is the Gulf region has become emerging markets. They moved from frontier up. So United Arab Emirates, countries like that moved up into that. If we looked at it in fixed income, not to confuse you, but fixed income looks at it by creditworthiness. So Mexico is a developed nation to fixed income because it's investment grade. So there are different ways to cut at it, but it roughly has to do with the size of their economy. Here's what happened to interest rates over the last year. Very little change. What's important to point is that the short end of the curve went up a little bit. Rates did move higher in anticipation, and the Fed obviously raised rates 1/4 point. And even the 30-year bond went up a little, but not as much. And the pivot point really has been around the 5 to 7 year range, where rates have stayed the same and not moved. So fixed income actually was a decent investment last year. I wanted to show you, this is GDP. This is the IMF forecast compared to the actual GDP of the region. This is a slide I showed you last meeting in November of the third quarter. So just look at the amount of green all over that slide, dark green and light green. There is some bright red in Brazil, but mostly a little bit of orange. Fast forward to where we are today, a lot more orange, a lot more bright red, very little green. And I would say that even if we brought it close, full date to where it is now, there'd be even more yellow across that slide. So again, a fair amount of the world doing okay in the third and fourth quarter, but then when you look at the first quarter of this year, with oil prices down, oil-producing regions are definitely in the red, and many of the economies are very, very slow. So it is a challenging time across the investment universe, as we had expected.
Chris, I spent part of my vacation in Ecuador and Peru, and it was kind of when the oil, it was a month ago or so, and all I could think of in Quito was just how dependent that entire country, it's had this emerging middle class. I mean, the last 8 to 10 years, their middle class has really grown, the economy is really strong, and now with oil prices down, they're so dependent on that
Yep.
I just kept looking around at all these people, and kind of going, what's going to happen in this country in the next 10 years, depending on oil prices. So it's interesting to see that chart and then just think of, smaller countries with smaller economies, and just they tend to have their eggs in a few resource baskets, and you just kind of
And the
worry.
power, as we said, of a resource going from $100 a barrel, where it had been for a long time, dropping to 20 very quickly within a year's time period. If you go back and look at Davos, they weren't talking about oil 2 years ago, and boy, they talked about it now, because it changes the landscape absolutely. So going up in the crow's nest, looking out on the horizon, the risk list is longer than the positives, and that, I think, is a reflection of the volatility in the market. Clearly, we're worried about global deflation. We're worried about a China slowdown. Is it a hard landing, a soft landing? Any one of those other dark clouds below that, if it was a major event, could trigger more of what we would call a big bear market, more of a recession. But right now, we don't see those as being a direct cause. And I want to highlight a couple of things in the CIO report that are different. If you turn to INV, sorry about that, INV 26 and 27. These are two research reports. We're just including them for your education and reading. But these are dedicated research reports I asked Josh Diedisch and the risk team under Stephen Tong to look at for us. And it just shows you at least the depth of what we're considering things. The first was to ask them about stress in the economy. What happens, and we know Syria is a live example, a sad, tragic example of where climate, you have a large population of adult men, 18 to 34, large unemployment, geopolitical problems, and then overlay that with climate risks that leads to food problems. And so we took a map of the world with those three screens: large male population that are young, unemployment, political instability, and climate change. And the top of INV 27 is that heat map that shows you what we think may well be the stress areas in the world over the next 5 to 10 years. We've shared that with our real estate, our private equity team, and other teams. And not that we're making any predictions, but this may well be the regions that other people as well are looking at as where you may see terror, upheaval, and certainly war and conflict. And then I would highlight in the middle of those pages on INV 27, I also asked them to look at what's the risk, do terrorist events cause recessions? Not a fun subject, but we actually went back and did the academic work on it. And the graphs at the bottom, I don't want to get into too much details, but the graphs show you that terrorist events cause fear, but they don't really disrupt economies. And the staff took the time to look at Britain, the U.S., other regions of the world that have had these types of attacks. And as you can see by those graphs, sadly, the percentage, the number of victims is what increases the likelihood of it causing a recession. So those are the kind of things we're going to look at and try and model and understand better as we try and be more educated about the risks. The world is certainly more complex and more difficult to analyze. And with that, I want to highlight to the public, we put a lot of information out on calstrs.com. A lot of our reports are out there, so please feel free to look there for information. We also post videos now every quarter about the portfolio, the asset allocation, or the performance and the cost of the fund, and those are out on the archived, available for the public to view.
Great, thank you. Questions from the investment committee? Seeing none? Great, thank you, Chris. Appreciate it. Item 8 we already did this morning. We approved the minutes from November 4th for open session minutes. So let's jump to number 9, our review of risk mitigating strategy asset class policy, our first reading. This is a revision, so Stephen, come on up. And I just wanted to mention to the investment committee, as Paul and I prepared for this meeting with staff and consultants, there was a request for another option to be introduced, and we tried our best to get that out to you as soon as possible so you could read that before our conversation today. So hopefully you've had time to take a look at it. If you haven't, we'll make sure the staff and consultants help us kind of navigate through this. I also just wanted to set up, that in this conversation, we've decided in November to allocate 9% into the RMS strategy. So we're really not rehashing that issue. We made that decision, and now the question is, within that 9%, the allocation, right? What are our options? And so with that, Stephen.
Stephen, as you jump in, you stole my thunder, so good job, Sharon. No, that's exactly it. You decided on RMS, so that's off the table. The question is what goes in it. And you decide this on every one of the asset classes. You pick an asset class, but you also set criteria for what the sub-asset class allocations is. So it may seem kind of granular and in the weeds, but you do that, just like we talked about U.S. versus non-U.S. in equity, high yield versus credit and structured governments in fixed income. So this is a case of where we have a new asset class, you're adopting a policy for it, and the big decision is what are the sub-allocations. Stephen's given you now 6 different options, kind of your entree menu of what you want to do, and Stephen and then the staff will go through their perspectives and then conclude with our recommendations, and we'll open it up to questions.
And I guess the only thing I would say is those are the 6 options we've been given. Obviously, this board, we can certainly give suggestions, or as we interact today, there can be a different way we look at it. So I guess I just want to make sure everyone's clear on that. These aren't set in stone. So, all right.
Okay. Thank you, Madam Chair, and good afternoon, everyone. Just want to sort of recap, Madam Chair, as you started off, and as Chris said, the most important decision that you've made is to include RMS within the asset allocation. The long-term goal, again, is 9%. Today is another important decision, but not as important as the decision made to include this new class. So today's goals was really twofold. First is to decide which of the 6 structure or possibly another structure might be appropriate for the class. And then secondly is your opportunity to review the policies for the new class. You have the option today to move and approve the policies that you're choosing. For your information, to help you come along and make the decision, we have some presenter today. And so we'll start off with Alan Emkin, your board consultant, and then Makita, Steve McCourt may have some information. Then you'll hear from staff. We have about 7 slides or so. And so we'll just review some of it and highlight some of the information. And then you'll hear from Lixor, who is our advisor on the global macro as well as the trend following, which is in the innovation program. So I want to just kind of start off and just talk about some key consideration factors. First of all, the most important thing that we kind of think about is diversification. The decision that you made last year when you talked about the asset liability is really diversification. And so as we think about that at the total fund level, when we construct a class or a sub-asset class, again, it's the theme of diversification. And the main takeaway when you think about diversification is having more is better than less. But having more doesn't mean that it's good. And so what we talk about is having more, but that they're uncorrelated with each other. And so what we've done is that we provide evidence for you in the agenda material to help you kind of understand how each component that we're proposing, what role it plays in the portfolio. So I understand that you may have questions around, the structure itself, and later on after the presentation, we'd be happy to answer those questions that you may have. I know you've looked at a lot of information, and some of it is easy to understand, and others is much more difficult. But what we're going to try to do today is really synthesize the information and just share with you what we think are the relevant things to help you make a decision. So with that, we talked about consideration factors. So diversification is really the key. And the reason why we talk about diversification is you heard earlier in Michelle's presentation in closed session just about the markets, and we think about the markets going forward, how volatile it will be, and the uncertainty of what may cause the volatility. So the key in when we think about volatility, what's the best way to address it in the portfolio context is really through diversification. So when we take that concept and we think about what's best for RMS, again, we think about including more strategies. So the key theme is you may ask yourself, and you should ask yourself, the effectiveness of RMS going forward. And so you've probably seen the probability statistics that PCA has really done a good job with. But what we'll also provide and supplement that information today is with historical information. And what the historical results will tell you is that it will confirm the hypothesis behind what the statistical information is providing you. And so it'll provide support. And it's really evidence that this RMS class, while we don't know for sure, it has a strong likelihood of doing what it's supposed to do. And we'll provide you some actual performance history. We'll reflect on 2015, and we'll reflect more so on the more recent volatility that we saw in the market. So I just want to kind of say that I appreciate you being patient and just kind of looking through all the information. I know some of it's difficult, but we just want to try to highlight what's really important, what you should pay attention to. So with that, we'll get into the presentations, and I'll go ahead and have Alan and Neil kick off.
Madam Chair, board members, Alan Emkin, PCA. I'll be very brief. I'm very brief, I promise you. You already made the big decision. The really important decision was the adoption of the asset class. You did that. You did that after a lot of discussion and debate. The goal of the asset class was to create an investment strategy that will do well when growth-oriented assets, which represent the overwhelming majority of the portfolio, don't do well, effectively trying to do well when the equity market and equity-linked securities don't perform well. That is the intent of this new asset class. all of the options before you accomplish that objective. Very, very important to keep that in mind. They all accomplish that objective. Their difference is at the margin. It's very important to keep that in mind. The reason to create the asset class was to mitigate downside risk, and all of the various portfolios presented to you accomplish that objective with small differences. It's really important in our business to be humble. All of the simulations are based upon a series of assumptions. If I could give you confidence that our ability to make assumptions which come true was good, I would be happy to do that. But there's no evidence that anyone in the consulting industry, or in fact anywhere else, can forecast the future. So we're all using judgment. But when you look at these numbers, basis points or tenths of a percent are effectively rounding errors. And it's just important to keep that as part of your consideration. So in short, as your consultant, what's important to us is that you adopt and implement the decisions you've made. Because as recent volatility has shown, and as Stephen's performance numbers will indicate, the advantages of having a better approach to managing downside risk can do nothing but benefit the plan in a volatile environment.
Stephen, do you want to grab before we go to Stephen?
question?
Sure. Yeah, hang on one second. I'll get you in there. Grant.
Thank you. So, Alan, you and Stephen both started off by saying we made the hard decision. We adopted the RMS strategy. And so I guess what I'm going to ask you, I'm going to put you on the spot and say, we've grappled with the idea of global macro, whether that should be one of the buckets within the RMS strategy. We have an option before us that doesn't include that. First, do you have a view on global macro? What are the pitfalls? And do you have an option that would I guess that's what I'm asking.
Well, let's be subtle.
Yeah. Thank you, Grant.
Hello. If I wasn't prepared before, I'm happy I got the Diet Coke.
So I figured
I
let's
appreciate
cut to the chase.
Let's do it.
I've been working with this board for over 30 years. I've had more interaction with the board and the staff and other consultants on this issue. Not the big issue of whether there should be RMS, but the structure of the RMS. And at the end of the day, the structure of the RMS is a rounding error, from my opinion. It is not where to focus. But to answer your question, there are lots of other options. Okay, so you could put together a different strategy which accomplishes the same objective using all or some of the vehicles that are presented to you. In terms of global macro, you have an existing program. That existing program has been successful. It's met the stated objectives, and we think it's valuable. It has done what it was intended to do, which is help diversify. At what level? That's a policy, a separate decision. Happy to share an opinion on that. But we believe that you need to diversify from just the two big buckets, which are long treasuries and trend following, and add one or two of the others because they give, as Stephen said, diversification and do well when the other two buckets may not do as well. And that's what the staff did in their research, is they show why that would be the case. But there are a range of options. The six in front of you are not exclusive.
Thank you.
All right. Tom.
So, I take your point that there are lots of options, and I'm going to ask other people to comment on this same thing too as we consider options. But the data we're looking at about risk management strategies looks at data over a period of time. And as we all remember from 2008, the biggest day when risk management strategies, there were specific days where risk management strategies were particularly crucial when everything correlated to one and markets were shutting down. And it's a little less important to us because we're not levered, but it seems to me that if we're looking at something that protects us against major downdraft, we should be looking for an asset class selection that minimizes the risk on not just a time of stress, but the days of maximum stress. And I'd sort of like you and the staff to comment about that as we kind of steer this conversation.
Anyone? Jump in, Neil?
Neil Rue from PCA. In terms of the structure that you have, it's driven by two major components, and then there's this other diversification question. The two major components are trend following and this long U.S. Treasury piece. In terms of major events where you might have significant short-term or even daily events, that's what the long-term treasuries represent. Around the rest of the globe, when that kind of thing occurs, everybody flees to the U.S. dollar and or something that's very close or equivalent to the U.S. dollar. So the treasuries pick that up in the beginning. And then for those extended other periods of crisis, and this is by design, that the trend following is going to pick that up after the treasuries sort of lose their gas after the emotional part of a crisis. And those are very big allocations in the RMS.
Yeah, so a lot would depend on the structure of our investment in a trend follower or a global macro fund, because if it's a fund, the fund could blow up in a day, or if it's that's really the heart of my question.
These strategies, and staff can probably elaborate in their prepared comments on these, but the trend following strategies in particular, and the ones that we're looking at for you on your behalf, will have some leverage in them, but that leverage is intended to be always cleared by the market intraday. So this isn't going to be something where the leverage extends out for several periods of time and you're all of a sudden your leverage is beyond the capital that you own. You have to clear it through the market at least at the close of every day. And these markets are highly liquid, and the request to exit these markets, if that was so desired, you could probably execute within a couple of business days. And that's by design, and all the vehicles that you enter into will have those characteristics.
Would that be the case in our most stressful days of 2008?
I'm highly confident that it would be. Now, you may lose principal, depending on how these things move. We would expect, hopefully, half of those a trend following vehicle is going to be trying to capture many different trends, not just U.S. equity trend, but a whole variety of trends. And those trends would be offsetting. So it's sort of, I don't know if we want to, it's difficult to say in a stressful environment like that all the trends are going the same direction in your portfolio. Some of them are going to be offsetting and actually helping you. So if you desired, if you were to desire to exit in such a situation, the issue about getting your principal back may not be as big as you might assume.
Well, and I think we're talking about in trend setting a separate account, so we can control the extent of the leverage. Yeah, okay. But anyway, for me, that's the big issue. I'm not as worried about the extended periods of time as I am the days of maximum stress.
And at the end of the day, in that crisis, that's the explicit role of the long treasury position.
Well, I know, but that's only part of the portfolio.
That it's either the first or second largest part of it, but with a very explicit role. The rest of the portfolio is really designed for other periods, longer periods of poor returns.
Right. I get that, except it doesn't work if they're vulnerable to explode in the day of maximum stress.
That's true if you're not capable of covering short positions and if you're highly levered, but that's not the design of the program. As a matter of fact, it's consciously designed not to suffer through that kind of experience.
Okay.
Stephen, did you want to, we're backtracking a little bit, but I wondered with like Grant's comment earlier, did you have thoughts or did you want to weigh in on that?
Yeah, sure. Just kind of more broadly, I would agree with Alan's introductory comments. I think you as a board should know that our impression anyway is that staff's analysis of the various options was very thorough. We did our own independent analysis of the options using different indexes, different time periods that showed the same results. So I think you're looking at good data. To Alan's point, we're looking at nuanced differences between the various options, and by far the biggest decision you've already made, which is to create the asset class. I would highlight that all of staff's recommended options have 75% of the asset class in treasuries and trend following. So I think what's under debate is really the remaining 25%. How is that allocated? Just to narrow this even further. And as you know, about 5% of the portfolio would be in global macro, just based on the current investments the fund has in global macro. So if you're assuming you won't divest from what you already have, you're really talking about 15% of the RMS to be decided upon. So this is a very narrow decision. As a board member, the one thing I would advise you of, because I agree all of these choices are good choices. We think all of these portfolios will work with modest differences. The biggest risk you have as a board is adopting a approach and a strategy that you're not wholly comfortable with. Because one thing I do know for sure is with 4 asset classes, one of them will look the worst in a year or in 10 years. And you don't want to be switching out asset classes every year, every 3 years. You want to have a conviction that they are going to work for you longer term so that you don't sell out of them at the wrong time. So this does, with that remaining 15 or 20%, kind of come down to a level of comfort that trustees have with the strategies that staff has identified.
Okay, Stephen, do you want to address? I've got a line of folks, but if you want to comment on that, and then we'll move through go ahead.
No, I was just,
Were you going to move forward?
it might be helpful if we could just go through our presentation. That might provide you with more information, but I'll leave it up to you.
I guess it's the pleasure of the board, but I do wonder if there's ways Grant kind of open the door to kind of try and just sort of talk about this. And I think even Stephen just now, I want to make sure I have my numbers correct. You're talking about treasuries and trend following being 75%. We already currently have about 5% in global macro, just currently, that's been in our innovation portfolio, right? And we can obviously decide keep that or not keep that, but that leaves us with the 20%, right? That's kind of, so I just wanted to make sure I had the numbers. Did you guys follow that? Mm-hmm. Okay, just so that we kind of understand what we're talking about, but okay. So I'm going to I guess I would like to hear from board members' questions, and then we'll jump back in, Stephen. Alan.
The minimum is 75% in those 2 strategies.
Right.
The maximum could be 100%.
Right.
It's just
Sorry,
very
I should
important to
have said,
keep that in mind.
Exactly. That's the minimum. Okay, thank you.
We're talking about INV 40, and we sent you a revised one with an RMS 6 listed on that. But those are the 5, 6 options, and those are the percentages of the 4 structures.
Great, thank you. Paul.
Yeah, so I sort of want to follow up on Grant's question, but maybe not be quite as pointed like, what do you think about global macro? Although I would be interested, but I guess I'm not going to get that answer. So let me ask it a slightly different way. So we have these 6 options, and obviously there's an infinite number of options, but we have 6 in front of us, and staff has recommended number 4. So what I want to ask the consultants is, in your opinion, are there, among the other 5, options that are equally as good as 4? You don't have to even tell me what they are. They don't have to be better. They just have to be equally good.
Do you
given the objective of the asset class, which is to minimize downside risk, the answer is unequivocally yes.
Stephen?
I would agree with that with one additional thought for you. This, like all asset classes, is a fluid decision. And as time moves on, you will have an opportunity to look at new risk mitigating strategies, adjust allocations, et cetera. So for me, the biggest point here is on paper, RMS4 is clearly the superior option based on historical data that we have. Acknowledging that the future is not going to look exactly like the past, I think Alan's absolutely correct. There's other options that get you close enough there.
So can you explain that? Because I'm looking for the page that I'm trying to find, and that is on INV 48, which shows how the S&P 500 did relative to these 4 strategies during periods of particular stress. And it seems to me, and I guess I'll take a little bit of a difference of opinion from what Stephen said, which is that I don't think the purpose of the asset class is diversification within the asset class. I think what we've been very clear about is we're setting up this asset class to protect against severe downside risks in the equity markets. And it seems to me from the data, the historical data on that page, that in severe periods of drops in the S&P 500, that global macro performs the least well, and therefore a substantial allocation to global macro wouldn't help us. Now, that's one of the reasons that I was one of the 2 board members who asked to see an example that included no global macro, but the other 3, and it didn't show appreciably one way or the other anything better or worse. Really, I think option 6 is about the same. But explain what you said, Stephen. That historically 4 did the best in protecting against severe downside risks. If that is, at least in this board member's opinion, what the purpose of the asset class is.
Yeah, I just to be clear, I think what I said was it's the on paper the best option on a risk-adjusted basis. If you look just at historical, very severe down markets, long-term treasuries are the strongest, and you would invest probably the entire portfolio in long-term treasuries. I think the reason to invest in 2, 3, or 4 is separate asset classes within our RMSs is twofold. One, long-term treasuries can be extraordinarily volatile in up markets, and I acknowledge what you say from the perspective of the purpose of this being risk mitigating, but I think in an environment where long-term treasuries are down 50%, which is very possible when rates rise, it's going to be hard for any board to stick with an asset class with that level of absolute return, even when the other 91% of the portfolio is going up. So I think I understand your point, but I think there is some credence to diversity within the asset class to mitigate sharp losses isolated to the asset class. The second reason to consider asset classes beyond long-term treasuries is related to Chris's chart below. This historical data exists completely in an environment of declining interest rates. And we think that in future crises, when the stock market is down 30, 40, 50%, rates will go down. But we don't know that for sure. And we don't know the future is going to reflect the past. And when you're looking at an insurance policy, I think there's wisdom to diversifying the sources of risk management. And particularly as we sit here with interest rates as low as they are, To me, it doesn't seem like a absurd proposition to take some of the capital and invest in other asset classes beyond long-term treasuries.
No, I'm not questioning that. I mean,
Yeah.
I think we're all. I don't think anybody is suggesting here taking anything other than the recommendation of staff and the consultants that we invest in at least three of the four strategies. I guess my question is, if we're going to have a substantial amount in U.S. Treasuries, whether it's 35 or 40 or 45, and we've got the rest to invest elsewhere. Why would we invest in global macro, given that the other two components can hopefully mitigate the losses that we would take when interest rates went up, and given that the primary purpose of the asset class is to protect against downside risk, and historically global macro has, on its own at least, performed the worst among the four in doing that. So couldn't we construct a portfolio, a strategy that excludes global macro but gets us all the same kind of protection and results as Portfolio 4?
Yeah, historically, yes, absolutely. And I think staff would say that based on their analysis, global macro historically has performed, is still protected, but performed the least well during severe market downturns. So if
that's in their report.
Yeah.
On INV 40.
Yeah. So it does, I think, come down to diversification. How much does the board value having, if you're looking at global macro, that fourth asset class in there as an additional source of risk mitigation, acknowledging it could very well be the least valuable of the four.
Okay, thank you.
Yeah. Thanks, Zach. Are you good, Paul?
Yep.
For now? Harry.
Just on that.
Oh, Carrie. Oh, did you want to respond? Because
Yeah.
I've got a line of people, so go ahead. Go ahead.
Well, just to add that we do see treasuries and trend kind of as the core of RMS, but in a range-bound environment or rising rate environment, just having those two will fail. So we need a third or fourth component to complement those. And where macro comes in is in those inflection points or those mild periods, which can still hurt and add up, but macro managers are able to take advantage of those types of environments and add to the trend piece when it's not performing. And SRP, it hasn't been tested through a crisis. We expect there's a lot of academic research to support that it would perform well, but really it's there for those mild periods as well to stabilize the RMS program. And if you take 2015, our live experience, macro and trend, they both did equally well. Trend produced 6% net return, macro produced 5% return, and treasuries and SRP did not add in 2015, but although trend and macro produced the same result for 2015, they both took very different paths and added to the portfolio at different times.
If I could just respond
go
to
for
that.
it.
I mean,
Sure.
Because my concern, and I don't think our concern here, is moderate volatility, whether it's 5% or 6% or 0. So I'm not sure that 2015 it tells us anything, because our concern isn't so much how these perform then. It's the concern. It's the concern in a bad market, and it's a concern that overall, they don't create the wrong outcomes, such as if we were 100% in U.S. Treasuries. So that's why I think the focus is more on extreme market situations.
Well, we haven't necessarily seen an extreme market situation since 2015, but our AUM is back to where it was in 2009. Granted, we've paid liabilities, et cetera, but those mild market corrections also can hurt us in that.
I think it's important to point out, Paul, I hear what you're saying. That's not why we recommended RMS. It's just for 2008 and just for the Great Depression. We would recommend a different strategy, and we only think those are going to occur 4 out of 100 years. We recommended RMS because of 1987, 1991, 73, 74, 01, 02, and 08, not just the extremes. If that's why you voted for it, that's fine, but I think I want to make it on the record. Staff and the consultants recommended it for those kinds of downturns, because when you lose a little bit less money on those downturns, you do a lot better on the rebounds. And that's why when we came to you and said the portfolio with RMS is farther ahead than without, because it does help in those periods. And what you're faced with is a recommendation. You wanted to see some split between the consultants and staff, and you have it. So they're recommending 3. They don't care which 3, but any of the 3. And staff is recommending RMS 4. And we can get into the explanation, so I won't belabor that. But I wanted to just be clear, Paul, I understand what you're asking. I think if we only developed a portfolio for those severe 08 recessions, I don't know that we come up with the exact same mix. We're trying to come up with something. If you look at your page INV 48, look at all those different types of we call them crises. They're not major, but we consider them negative markets. We're trying to develop a basket of strategies that do the best in a variety of past bear markets, knowing that a future bear market isn't going to be exactly the same. All we can do is look in the past and say, okay, here's what would have worked the best in the past.
And so I guess maybe we do have a difference of opinion about why we need the strategy, because I think when you tie our investments to our funded status, then I think we do focus on those severe events, because I think, at least for me, trying to understand risk, I think we often separate the consideration of risk on the asset side from consideration of risk on the liability side. And I think as a board, we need to try to put the two a little bit more together, which is why I think the work that PCA has done to talk about the 64% threshold and a couple of other things like that is really important. Now, within the rounding error, all 6 proposals pretty much get us to the same place with respect to those metrics. So it doesn't really help us. What it does do is it really shows that the RMS strategy helps. Whichever of those 6 we choose, the RMS strategy helps a whole lot compared to what we're doing. So that's really good to see. But I do think that concept of trying to tie the assets to the liabilities is as we evaluate risk is something that we should be thinking about, and maybe we need to think more about how we do that. What the appropriate way to do that is, because we've sort of just kind of tumbled into what Alan and Neil have suggested, which I think has been very useful. But maybe you're right, Chris. Maybe there's another way of measuring what the risk is and how to tie the two together.
It's measuring the shortfall risk, which we started a year and a half ago, and we put on hold. I want to be clear, especially to the audience in the back. Your first line of defense, your first risk mitigating strategy is diversification. You don't put all your eggs in one basket. So the severe downturns, you're still going to have, as we've shown you, 85% of the portfolio exposed to GDP risk. You can't get enough diversification in those severe downturns. That's why you're adding the RMS strategy. You're still going to lose money in those downturns, and you're still going to lose funded status. We just hope not as much. And so the question is, remember we talked about this is sort of like buying insurance. If there was an insurance product, I'd be the first to sell it to you, but there isn't a perfect one. So what we're recommending is a bundled approach of a multiple set of policies we think will protect you and help you in the next bear market.
Move us on, Harry. Got Harry and then Betty. Do you remember?
Yeah, I do. Thanks. They're probably pretty elementary questions, and I apologize to those that may perceive them as such, but for my own clarification, I like to have these questions answered. So this is about protection on the downside. It's essentially we're exposed to, we have a big bet on global growth. That's what a pension fund does. And this is saying, well, we might be moving into a slower growing environment and downturns, corrections, severe events. This strategy is more likely to inflict less pain. And a question I have about the RMS is around U.S. Treasuries. Currently, we have about 15% of the total portfolio in Treasuries. Does the percentage of the total portfolio exposed to Treasuries grow as a result of this decision? Or does the Treasury bucket as we currently know it get sliced up differently and that percentage relatively stays the same?
The latter.
Stays the same. Okay. Okay, thank you. Second question has to do with, I see this as this is an attempt at further diversification of the portfolio, and probably the one tool that we have in the toolbox to protect to protect the fund. But as I look at the RMS and I look at the buckets within the RMS, I'm looking at what's the greatest diversification within that diversification. For example, we could make 100% allocation towards treasuries in an RMS, but that wouldn't be diversified. So is the recommendation number 4 the most diversified RMS structure of the options that we have?
The answer to that is yes, it is, because you have 4 different vehicles, and 2 of them are not highly correlated to the other 2 major vehicles, so it's more diversified. But at being a devil's advocate,
Yes.
the question becomes, do you need to be diversified in every part of the portfolio? And in this case, what you're effectively doing is diversifying away from the very purpose that you've established the class, which is to mitigate downside risk. And there is a role, and the role for those other vehicles is during periods that aren't catastrophic or aren't deep losses, and they will generate positive returns, and hopefully those positive returns will offset the fact that treasuries and trend following might not do well at all. But it's just important to go back to what is the role of the portfolio. And you can over-diversify.
Well,
So
if
yeah.
you over diversify, you're going to lose
The
you know,
benefit.
the benefit of the class in the first place.
Another question around global macro. We received we received a lot of information about global macro, and one thing I've learned around private equity is if you don't have exposure to the top quartile managers in private equity, you better not be playing in that space, because you could get the same type of risk-adjusted returns in a passively managed public index fund. That is pretty clear about that. Is there data that disaggregates performance of global macro managers? In other words, the data that I've looked at just shows how global macro has performed over an extended period of time, but I haven't seen anything that disaggregates top quartile performers to bottom quartile performers.
Fabian's shaking. You want to say something, Fabian?
Yeah.
Or-
This is Fabian Pavlovsky.
Your microphone, Stephen.
Sorry. Hi, I'd like to introduce you to Fabian Pavlovsky, and he's with Lixor Asset Management, and he's the head of U.S. product development, and he's had experience in hedge funds for 14 years, and he could probably speak to your question.
Sure. Hi, good afternoon. On your question about the dispersion of the performance of the global macro space, we do have the information, and it is something actually we spend a lot of time talking to the staff about, the fact that manager selection is critical. So it's very true that when you look at the set of analysis that you have, what you're seeing is the average performance of a macro hedge fund. But within that number, a lot of dispersion is hiding. And I think your comment about the top quartile managers being worth investing, the rest not necessarily the case, I would side with that and as being true.
And then I would just put this out, Madam Chair. Whatever decision we do make, I think it's critically important for us as a board when we plan, then we act. Today is like we're taking an action. At some point, we have to have something agendized that we evaluate the effectiveness of the decision we make.
Right.
And we should clearly, explicitly have that on the record that at some appropriate future date, we evaluate and adjust accordingly. And we may decide to be in the global macro space, increase the commitment that we currently have, which is about $1 billion. We may decide that we want that in the portfolio, in this RMS today. We may decide we don't want it in the space today, and nothing prevents us from coming back at an appropriate time to say we want to move some of this into one of these other strategies.
Yep.